Now, what are the right measures or what are the good liquidity measures for companies to have? Well, working capital in general, we want it to be positive. Is it bad that Walmart and Target have negative working capital? Not necessarily. Perhaps it raises a yellow flag. What we want to look at is consistency to make sure those current liabilities are not getting larger and larger in proportion to those current assets, that it's not getting more and more negative of working capital. Current ratio, the rule of thumb is we generally want it to be greater than 1, but not necessarily bad if it's less than 1. We'll take a look at some reasons why a company might actually want to have a negative working capital and a lower current ratio, what the benefits are in a moment. Quick ratio, do we want it to be high? Higher is safer, but there can be advantages to having lower numbers as well. We want to factor in other situations. What if we take a look at a company that hasn't been doing so well? Tupperware very recently has filed for bankruptcy. I hear that some of its assets have been frozen. If we take a look at how Tupperware performed, not a competitor to these companies, but just to see what some numbers could look like of a company not doing well. Tupperware's most recently reported balance sheet is as of fiscal year end 2022. They still haven't filed for 2023. And we can see that the total current assets, $431.6 million. Compare that to the current liabilities of $1,001.9 million. That's going to give Tupperware a negative working capital of $570.3 million. Okay, so just compared to dollar amounts, it doesn't look terribly different than Target, and it's still significantly lower than Walmart. But if we look at current ratios, we don't expect the company Tupperware to be nearly as big as Walmart. So how big of an impact is it? How low is the current ratio? When we put the current assets of 431.6, compare them to, or see how much greater or less than 1 they are compared to the current liabilities, we get a current ratio of 0.43, and we can see that that's much, much lower than any of the 3 companies we've just analyzed. The quick ratio, see what assets we're including in the quick ratio. We have cash and equivalents, accounts receivable, and we're also going to include non-trade receivables. So we're going to drop out the inventories and the prepaid expenses and divide this by the current liabilities, and we're going to get a quick ratio of 0.19. Now that's not terribly different from Target or Walmart, but we see that the current ratio is significantly lower than all of our other 3 companies. So why wouldn't we want our current ratio to be very high and our working capital to be very high? Well, let's look at some of the trade-offs with some of our major current assets and current liabilities. What are the issues with having some of these accounts too high or too low? And the first one we're going to look at specifically is cash, because we have different factors in our current assets and our current liabilities. Obviously, if our cash amount is too low, let's look at the most obvious first. We can't pay our bills, and that's not going to be good. We don't want to have to borrow on a long-term loan with interest in order to pay our bills. Take out a loan and incur interest. And we also may have some, if we don't have cash, we may miss out on some investment opportunities. Purchasing a subsidiary, expanding our operations in new markets. Even things like being able to buy shares of our own stock as treasury stock. Okay, so that's pretty obvious, but why might we not want our cash to be too high? Well, there's really no, or sometimes in like a checking account, very, very low returns. Related to that, there's an opportunity cost of other investments. If we have a whole lot of cash in the bank, we are not taking that cash and expanding our operations in new markets or purchasing subsidiaries, increasing our businesses. If we have a lot of cash, and we also have loans outstanding, like perhaps we have some loans financing our plant, property, and equipment, what we may end up with is having an interest expense on those loans, on debt, that exceeds the interest that we're earning on our cash. I mean, just in a checking account, we're probably not going to have any return whatsoever. But if we have short-term treasuries that we're investing in, they're not going to give us much, and we could be paying a whole lot on our debt. Perhaps it's better to just take some of this cash and pay off the debt and lower our interest cost. Another thing is investors may expect dividends if they see that the company is holding a lot of cash. Let's take a look real quick at Apple's balance sheet. What do we see for Apple here? Cash and equivalents. These numbers are in millions. So 30 billion in cash and equivalents, 32 billion in marketable securities, short term. Long-term marketable securities, 101 billion. So $163 billion in cash and securities out of their total assets of 352 billion. That means 46% of Apple's balance sheet of their assets are sitting in cash or investments. Now, investors could, shareholders of Apple stock might say, I can invest my own money. I'm investing in you, Apple, so that I can earn the returns of you making your products and selling them to customers. Why are 46% of your assets invested in cash and stock securities? Let's look at the trade-off with accounts receivable. If accounts receivable are too high, we are providing perhaps too much free financing to the customers. Maybe there's other, if we had gotten the cash from them instead of waiting for the cash from them, we could do more with it. We are acting like a bank without interest. Obviously, the accounts receivable turnover ratio can be used as a liquidity measure to determine whether we're collecting our receivables fast enough. And with this free financing, it also relates to perhaps missing out on investment opportunities if we don't have the cash. Now, if our accounts receivable is too low, we might be collecting our cash very quickly from our customers, but it's possible, and we should be checking to see if we may be missing out on sales. Are we perhaps losing sales if the company's credit policy is too strict? Let's look at the trade-off with inventory. If inventory is too high, we run the risk of obsolescence, our goods becoming no longer useful or deteriorating in value over time and changes in technology. Where something like a supermarket, we could have spoilage. We have too much inventory. We have a lot of inventory. We have a lot of storage costs. We need to pay rent, purchase our buildings and stores. We're going to need to have insurance and utilities costs related to the areas in which we're storing our goods. And also, like we said before, opportunity costs. Instead of having all of our capital, our cash tied up in inventory, maybe we could be doing something more productive. And again, just like the way we talked about the accounts receivable turnover, measuring whether accounts receivable are too high, we can also look at the inventory turnover ratio to see if our inventory levels might be a bit too high. Can inventory be too low? Similar with the receivables, if our inventory levels are too low, we do need to question, are we losing sales due to stockouts? Do you remember during the pandemic trying to buy toilet paper That's what type of stuff that we're talking about, at least having enough inventory to be able to appease our customers. And turning to the current liabilities section, if we look at accounts payable, we don't want them to be either too high or too low. The risks of our accounts payable being too high, well, the most obvious is credit risk. Maybe our suppliers are going to say, no, you owe us too much. We're concerned about not getting paid. We're not going to sell to you. And then related to that, it may impact the relationships with our suppliers. And if we lose our suppliers, we could be in operational trouble as well. If accounts payable are too low, well, then we're missing out on free credit from our suppliers. We're ordering these materials from our suppliers. We can probably hold out on paying them for 30, 60, or 90 days, whatever the credit terms are, and we don't have to pay any interest on that. So it's a free loan from our suppliers, which is nice to be able to take advantage of. So what is the right amount of working capital, the current ratio and the quick ratio? We know we don't want them too high. We don't want them too low. We want them somewhere in that Goldilocks zone. What is that Goldilocks zone? Well, unfortunately, it's difficult to tell. A manager will eventually get used to what works for the company. We want to be competitive with our industry peers. And of course, things affect all companies like the economic factors. So it's not easy to say exactly what the numbers should be, but whether we are managing appropriately.